Welcome to Supercool, the show about real-world climate solutions that cut carbon, boost the bottom line, and improve modern life. Each week on Supercool, we go behind the headlines to pinpoint the stories and data accelerating the low-carbon economy in towns and cities across the U.S. and around the globe. I'm your host, Josh Dorfman. In 2018, about 7 years ago, I was wrapping up one of the most rewarding jobs I ever held. I'd spent the past several years building and leading Asheville, North Carolina's startup community, an initiative called Venture Asheville. It was an unconventional setup. I was employed by the leaders of economic development and the Chamber of Commerce to create the right conditions for local startups to thrive. Having worked previously for startups in New York, San Fran, and LA, I knew none of those places were going to give me this kind of opportunity to guide a startup community from the ground up. And Asheville was on the rise, already showing up on many best places to live lists. So I figured I'd give it a shot. By 2018, our startup scene was making some noise. Not a ton of noise, but pretty good for a small city in the mountains of Western North Carolina. And then one day we had a visit from a venture capital partner at New Enterprise Associates, more commonly known as NEA, one of the largest and most reputable venture capital firms in the country. So I hosted a conversation with her and a bunch of our local founders. If you work with or know startup founders in cities outside of major cities, you've probably heard them complain about the lack of local funding opportunities and access to capital. Asheville was in that camp. Right or wrong, founders pretty much everywhere feel that way. So during the Q&A, one early stage startup founder essentially pitched his business to this venture capitalist. And good on him. He had the mic, and if you're a founder, you've got to be opportunistic, proactive, and take your shot. It was actually the investor's response that surprised me. Essentially, she said that his startup sounded really interesting. He had traction, the tech seemed differentiated, he and his co-founder had strong backgrounds. However, she wasn't interested in investing. In fact, she wouldn't even consider it. Why? The deal was too small. NEA invests hundreds of millions of dollars, generating the kinds of returns their own investors who put money into their funds demand precluded NEA, at least at the time, from doing small deals. They don't have the bandwidth or human capital to do the due diligence for doling out small checks, by which I mean checks for several $1 million at a time. They need to be doing 20, 30, 50, $100 million deals to make their business model work, given how much money they must deploy and earn over the 10-year life of their fund. Well, you can imagine how well the room took that news. It was crickets. Huge letdown. And her response stayed with me. Everyone knows raising capital is hard. It takes a long time. You mostly get rejected. It happens to nearly every startup founder, and it certainly happened to me. And finding that alignment with the right investor who is prepared to write the check size your venture needs adds another layer of complexity. You can have mission alignment. You can have the feels for each other. But if it's a growth fund in your early stage, or it's an angel investor in your growth stage, the deal simply won't happen. I was reminded of all this as I thought about today's show, because today we're digging into how the clean energy revolution gets financed. We're looking at where all the trillions of dollars required to wean civilization off fossil fuels and accelerate us into the low carbon future are going to come from. If you're a listener of the show, you know that most weeks we're featuring guests who run some of the most incredible climate tech companies on the planet. The solutions range from electrifying school buses to giving your local Taco Bell a deep energy efficiency retrofit to pulling heat out of sewer water and reusing it to heat and cool thousands of homes and millions of square feet of commercial space. We talk about all of this innovation, how these founders and executives build remarkable companies. But the question remains, who is writing the checks? And how do big deals, investments in the hundreds of millions or billions of dollars in clean energy and related technologies come together? To walk us through the mechanics of financing the clean energy revolution, we're talking with Britta Von Oesen, partner and managing director at CRC, the nation's foremost investment bank dedicated exclusively to financing the clean energy economy. The firm has advised parties in over 350 deals worth over $72 billion. That's resulted in 123 gigawatts of clean energy for projects that offset over 170 million tons of carbon dioxide. We're talking about big impact. CRC is the #1 renewable energy advisor in America by deal count for 5 years running. Britta herself has led over $15 billion of transactions for the firm. As one of the few senior women in renewable energy finance, Britta has received multiple industry awards, including the 2020 US C3E Finance Award by the US Department of Energy, the 2020 Most Influential Women in Business by the San Francisco Business Times, and Renewable Energy World's Solar 40 Under 40 in 2018. Today, Britta is taking us behind the headlines and these super inspiring projects like massive utility-scale battery storage, community solar projects that span 5 states, and a $1 billion solar project in the Arizona desert to understand who's writing the checks, why they're writing the checks, and how these deals come together. We're living in a very unique moment when the financial incentives and projected returns for investors provide all the necessary motivation to pony up. Yet all these deals propel us toward a more sustainable world. And Britta isn't asking some of the biggest companies, industries, and investors on Earth to invest out of a concern for saving the planet. She and her firm are succeeding because financing the clean energy revolution makes smart business sense. That's wonderful news because the deals she puts together don't just cut carbon and deliver a strong return on investment. They also improve modern life for people and communities. Here's our conversation with Britta. Britta, welcome to Supercool.
Thanks, Josh.
We chatted a little before, and I mentioned that we talk on this show with a number of startup founders, CEOs, mayors, policymakers who are driving innovation, creating products, creating services, or implementing new policies that unlock all of this really exciting innovation. And this is our first opportunity to dig into the financing side. Like, how is the clean energy transition, the clean energy revolution, how is it being financed? How is it being underwritten? And I think that that's such a hugely important topic for all of us to understand because I actually don't think it's readily understood. And it's so crucial to everything we're trying to do. So I really appreciate you taking some time to speak with us today.
Of course. No, I'm excited to be here. This will be good.
Cool. So here's where I want to start. So I was just looking at some of the latest press releases and announcement coming out of CRC, and I was actually reading the blurb that's on the bottom of these releases. And so just one sentence that jumped out at me from that, this is quote, "Our belief since inception is that every transaction is a catalyst for change. Every closing, a step toward a cleaner future. To date, we've executed 350 projects and corporate transactions for sustainable energy assets valued at $72 billion. So huge numbers, $72 billion, lots and lots of projects. But I was looking at that and I thought, wow, if I were an up-and-coming investment banker and I read that there was an investment bank, an advisory firm that said that they believe every transaction is a catalyst for change and a step closer toward a cleaner future, that's where I'd want to go. So my question is, like, what's it been like for you? Tell us a little bit about the culture at CRC and what you do, your experience there.
Yeah, well, it's actually interesting kind of towards my own history. I never dreamed I would be an investment banker, right? I've been a staunch environmentalist. I've always been passionate about the clean economy, et cetera. And when I kind of made this transition in school to focus on banking, it all of a sudden occurred to me, oh my gosh, what kind of incredible impact can you have if you're actually shaping the capital markets and the financing of all of these projects to actually really move this needle. I've been with CRC now coming on, 11 years. I'm a partner within the firm, and we have really built this organization to focus both on incredible financing structures, creative tax solutions, all of the super geeked out, tax accounting, investment banking components, but also really focusing on that catalyst for change. It is a passion amongst every single employee we have and is a critical component of who we are. So we are entirely devoted to what we call the energy transition. So that can range from carbon capture to hydrogen to solar, wind, storage, energy efficiency, EVs, all of those different components. And it's just been an incredible growth story as well as we've kind of grown up next to this industry, that it really is having an incredible impact on the clean energy environment.
Yeah, it's fantastic. And I would think it's just such an interesting seat that you're in to be able to I mean, affect, but also view and watch how this has really transformed and unfolded over the last decade, given all the projects that you and your firm have been involved in. So has that felt like momentum? Has that felt like things
Oh,
are,
it's been
I mean, I
incredible.
assume it has to. Yeah.
Yeah, I mean, 11 years ago, we were super excited to be raising, $20 million for projects. And that was one of our biggest deals, I think, in 2013. And that was a huge deal. That was awesome. 5 years later, we're selling companies for $1.6 billion. A couple of years later, we're raising, billions in single transactions for individual projects that are out there. So it's been an incredible ride. Yeah, a lot of fun.
Awesome. Okay, so here's what I want to do is, as you said, we're talking about finance today. We're talking about complex topics. We're talking about complex, in some instances, financing vehicles. I've watched a recent interview you did. It was really interesting, informative, but I still was a little bit lost at times. I was on with NASDAQ, right? So that was probably about a month ago. And so what I'd really love to do is dive into several specific technologies, projects that CRC recently announced where your firm was an advisor in those deals, to kind of understand how those deals come about from the financing side, who the players are, the entities when we talk about investors and asset owners, and just kind of drill in so we get a real crystallized sense of like, okay, what does it mean when clean energy projects are being financed and how this all comes together. So if you're game for that, then I'm just going to jump in. Is that cool?
Yeah.
All right, let's do it. Okay, so I want to start with one that certainly I think is super cool and not commonly known or understood because this is a fast emerging trend. And this is really about commercial scale or even utility scale battery storage and how fast that industry is moving, meaning, that we talk about solar and wind and intermittent energy and the need to capture that energy so it doesn't get wasted. You need storage on the grid, but this is really moving quickly. And one thing that struck me, so we'll start with this project. CRC, it says, recently announced the success of a battery storage project in Texas where your firm advised Key Capture Energy, a premier developer, owner, and operator of battery energy storage systems across the U.S. Big project, 200 megawatts, sounds big, I know it's big. But here's what struck me as so interesting when I read this press release. The press release, given equal weight in the press release, was the announcement of this huge battery storage project in Texas and the announcement of the fact that they had successfully done the ITC transfer. And I was like, okay, let me go Google what an ITC transfer is. And I was like, okay, investment tax credit transfer. I'm going to ask Britta about that. So it was two things. It was like, just help us understand that vehicle and then help me understand why both things are so critical that they would actually be in the headline of that press release.
Renewables finance is significantly driven by tax credits. And there are two different kinds. There's the investment tax credit and the production tax credit. And one is based on how much it costs you to build the project, and the other is based on how much energy you produce. So traditionally, it was only wind and solar that were included in this from a technology perspective. And the IRA added standalone storage. It added a host of other kind of technologies to really expand this. And the beauty of these tax credits is they really provide a catalyst to lower the cost of energy, right? If there are these significant tax benefits, you're providing a very low cost of energy for the off-takers, for the consumers, which has been very beneficial to the industry, especially in its growth trajectory. That being said, these tax credits are not a cash credit, right? You are not paid out in cash for these. They have to offset income. So in almost every case, the people developing these projects don't have a large enough income to actually utilize those tax credits up front. And so we bring in a tax partner, and that is any of the banks, any of the major insurance companies are all playing in this space. And we're seeing a huge number of corporates come and participate in this space as well. It's a no-brainer, right? If you have a certain amount of income, buy some tax credits at a discounted price and pay less taxes and promote sustainability. That's a win-win-win for everybody. So for Key Capture, who is one of the prominent storage developers in the industry, we are working with them as our client. And so our job is to finance the entire capital stack. So for example, if it's $100 project, you might have as much as $30 coming from the tax investor. Another portion, call it another 50, is coming from debt, and then 20 is coming from equity. So you really cannot consider investment in renewable energy and standalone storage and really any of these emerging technologies without considering the tax piece of it.
Okay, so thank you for that. Let me drill into a couple of things that you said there. So just to start with some definitions. One of the things you said was you had mentioned the off-takers. What's an off-taker?
An off-taker is the purchaser of the power.
Okay.
So if I build a solar plant or a storage plant, it is who is purchasing that power. If it's standalone storage, you're not actually creating power, but who is utilizing the battery.
Okay, gotcha. So we're talking about the off-taker, who's going to utilize it, we're talking about the people developing it, in this case, Key Capture, right? So they need an off-taker, or someone's got to buy the power. But to pull this deal together and get it done, you come in and you advise and say, okay, well, some portion is going to be equity. You're going to go sell some percentage ownership either in the project or in the company, I guess maybe both, depending on the scenario, right? Okay. Some of it's going to be debt, much easier to understand. We're going to go find a big entity, and you said an insurance company, a bank, it might actually be a corporation who's going to say, well, I could really use that to offset taxes because I'm a big entity, I'm profitable. So if it's a $100 million project, $200 million project with that 30%, right, we can use that, right?
Right.
And pulling that whole thing together, then you as CRC or you as Britta, you can advise your client and say, okay, yeah, like this can be done profitably now. Is that
That's exactly right.
Yep. Okay. And so in that case, and you mentioned the IRA and the Investment Reduction Act. So, and I think I know the answer, but it's not, but the IRA has been a massive catalyst then to unlock a lot of this type of opportunity. Is that accurate?
It has, specifically in these technologies that weren't previously covered. So wind and solar, it didn't make a huge change in the existing policy, but for things like carbon capture, standalone storage, hydrogen, electric vehicles, it has been a major catalyst for growth. And the storage is so critical because you cannot achieve a lot of these renewable energy targets of 50%, 100% renewable without a huge amount of storage build out, right? That's a critical component.
Yeah, no doubt. So now I'm going to ask a question, and I'm just going to operate under the assumption that there's no such thing as a dumb question. So I see you smiling, you're not rolling your eyes, so thank you.
No, I love it.
And so my question is, I'm a big giant company, I'm going to have a huge tax liability, and you come to me and you say, hey, we've got this project and it's got $30 million of tax credits attached to it. Like, do you want that? What does that look like? I get how that transfers money to the project, and I get how I'm offsetting my tax credits, but is that how I think about my return as the company? Is that everything that's involved?
So that is the most simple way to do it, is a simple tax credit transfer, right? Which is I pay you 95 cents, you give me back $1 of tax credits. Everybody's happy. I file my tax return the next year and I offset with that. We are working with a large number of corporates we're working both on the sell side and the buy side. A lot of corporates who want to figure out how to take advantage of this are working with us as well to navigate that. There is a much more complicated structure that is the tax equity partnership, in which case you actually end up as a partner to the long-term owner, and you're taking both tax credits and some of the depreciation and a portion of the cash. We're also doing that. That is less common. Today, most of the corporates that are looking to get into this are looking at the simple tax credit transfer.
Got it. Okay. I understand it now. So the last question on this one before we move to the next example, why is it so either important or impressive or worth noting that it kind of had equal stature, this notion of the ITC, that we did the project, because I'm thinking, like, if I read about this in whatever comes across my social feed or whatever, hey, 200 megawatt battery storage project in Texas, I'm like, holy cow, that's progress, that's awesome, I want to know about the project, right? But I'm not thinking, ooh, did they nail down that ITC transfer? Sure, I hope so. Like, Talk me through that.
So the tax credits are very much the tail wagging the dog, right? It is the biggest supply demand imbalance in renewable energy finance. It is improving with the number of corporates coming to this, but it is complicated, and it is, time out of people's normal day-to-day accounting and finance roles to figure out how to utilize these credits, which is, again, why we are working some on the buy side to help corporates navigate this. But the number of tax credit buyers versus the number of projects out there is pretty imbalanced. And so achieving that is kind of the final linchpin for any project to move forward. It's the final hurdle that you have to make sure gets done, and it's not always achievable.
Gotcha. Okay. So in this case, it's really signaling something to a certain readership or audience about the validity, the credibility that this project is like signed, sealed, delivered. Like
that's right. The project is getting built now, right? It is fully financed. There are no remaining questions.
Okay, cool. All right, we're moving on. All right, so example 2, and again, what's so exciting, and I know the CRC has done so many projects over the years, but that was announced like a week ago. So this is a very fresh for this battery storage project. And then just a couple weeks before that, your firm announced this project, and I'm going to read a little bit so it's really clear what this project is. And there's a bunch here that I find really interesting. So it says, CRC announced that it advised Walmart, world's largest retailer, in providing equity investment into a community solar portfolio of 31 projects across 5 states. So let me just read a little bit about what that means, because when I read it and I thought, wow, Walmart's doing this is really exciting. And then I thought, okay, and CRC is advising Walmart, we got to understand what this means. So Nexamp is actually the community solar developer. So they issued a press release and they said, Nexamp partnered with Walmart to develop 31 community solar projects across the US. These projects are expected to generate more than 120 megawatts of renewable energy for the grid, create over 1,500 jobs, and provide millions in consumer savings for local businesses and approximately 8,000 residential customers. And then it says the community solar projects will focus on providing the benefits of affordable renewable energy to subscribers from 5 states. Nexamp's model for community solar allows residents to subscribe to solar energy without the need for rooftop installations, giving them access to the benefits of clean energy and lower utility bills. And it says customers can expect to see significant savings totaling more than $2 million per year. So you read that and you think, hallelujah, this is it. This is exactly the kind of, that's incredible. 31 of these projects. You don't even have to have solar on your roof to participate in all of this change, right? So that's for, in the world I operate in the world that most of us paying attention to the clean energy transition, that's what we see. I could go get Nexamp on the show and be like, hey, that's super cool. Tell me about the project. But then behind that is the firm, like how this thing actually got financed. So one, it's interesting that it's Walmart doing it, providing the equity financing. And 2, you or your firm advised Walmart on this transaction. So can you talk us through that? Like, what does it mean to advise Walmart? Like, what is that kind of advice? How does this come together?
The growth of community solar, which is really a state policy driven industry here, has been transformative to both the distributed generation and the residential space, right? You no longer have to have solar on your roof. From a cost perspective, you're able to build kind of one larger project and then distribute that out to a large number of residential or commercial industrial tenants. So there are a lot of states leading the way on this and improving policy. It is a slightly fragmented market because each state has slightly different policy, which can be complicated. And folks like Nexamp have done such a good job of really figuring out how to navigate all of these different channels. So it takes a really strong developer like Nexamp. And then you partner with somebody like Walmart, and Walmart is making amazing commitments in the sustainability and renewable energy space. And they're doing that both from a tax and equity perspective. So talking back on that much more complicated investment structure, we are advising them on that. And so they're able to come in and utilize, some of the tax benefits, which is wonderful. These projects don't get built without a corporate partner doing that. And in addition, they are taking some of the equity risk. So taking an actual equity stake and riding along longer term as far as the performance of the projects. So again, we are advising corporates on activities like that, and Walmart being a prime example, because it is complicated. It is highly nuanced tax structuring, which is not most accounting groups' day-to-day focus on how to implement renewable energy tax benefits into their corporate balance sheets and income statements. So that is a huge growing portion of what we're doing. And it really takes very strong and committed corporate partners like a Walmart to get this moving and get it done. So yeah, they're being highly influential right now.
Yeah, I could absolutely see that. And one thought that jumps out to me is, okay, so 31 projects get packaged together, right? 31 different community solar across 5 states. Maybe is that a big enough project where a corporate comes in and says, okay, this actually is now at a level where it's actually worth our literal time, right?
That's
to actually
right.
go do these deals. Is that, yeah?
That's exactly right. And it's not without headaches, right? It's 5 different states. It's all different, programs. It's different landowners. It's complicated, but it does take the commitment of somebody like that to come in and actually get it over the finish line. And a group like Nexamp is able to then amass enough scale to garner the interest, right? There are groups that are doing much smaller deals with smaller corporates, but if you're going to get Walmart to the table, it's got to be a pretty big check.
It was an education for me, even just in the venture capital world, when you look at some of these really huge funds, some of the best funds in the world in NEA or whomever, and you hear their partners talk about the fund, and it's like, oh, yeah, we love all these emerging technologies, but the deals are too small. We just don't have time. Like we just, right? Like we have to deploy so much capital, or our numbers are so big that we have to focus on bigger projects. And it makes sense that that's happening here. Leaving kind of Walmart out for a second, just is this something just in general with corporates that you're seeing them maybe coming to your firm looking for these types of projects, saying, hey, what do you have in the pipeline? Do you have clients doing this type of thing? Or does it come from kind of the corporate side, from maybe the Nexamp side, the developer side, both? I mean, what does that look like?
Yes, it's both. Again, I spoke a little bit about the supply-demand imbalance. So the developers are primarily who is coming to us because they are in much more need of trying to source the tax credits. But especially after kind of post-IRA, we are seeing an increase in the number of corporates that are coming to us. And that is something we can do quite easily, right? Is sourcing opportunities for them to acquire tax credits or make a kind of tax equity investment.
Okay, understood. And I guess at this point, for CRC, you're so well known in the industry, you've been around for so long, you have your reputation, your experience, you can go find deals. Like if you have someone who's like, hey, we got $1 billion, like we're looking for some tax equity.
Oh yeah, I can deploy that within a week or two. No issues.
Yeah, let me send a couple of texts. We'll get that done. Okay. And then as far as a project, whether you can talk about the specific project or kind of projects like this, when you say someone takes an equity stake in a solar project, and there's another solar project I want to talk to you about, what is the kind of return that the investor or the equity partner, like what is the expected return? How do they think about that?
It varies pretty significantly. From an equity perspective, there's all types of varying components that go into it, right? Whether they're preferred in the cash waterfall, how long are they staying in? In most of these cases, you have to stay in for at least 5 years, not in a tax credit purchase, but if you're making the equity investment on top of that, you have to be in for 5 years. So a lot of these groups are looking at like a 6, 7, 10-year return target, and then they want to be bought out. Some are in for the long term, some are staying in for the 40 years that the project is expected to operate. So it really varies there. You're looking at a premium above debt, right? You're looking at somewhere in the high singles to low double digits. A lot of these investors also, because it is a somewhat short time frame, are looking at MOICs, so kind of multiples of invested capital instead of an IRR. So it really runs the gamut. And one of our main jobs is figuring out how to structure these investments in an optimal way so the investor is achieving their return, but also we're optimizing for the project owner and making sure they're getting the best they can too.
So that both sides are winning and the project is actually on solid footing and is going to succeed as well. Okay. So I'm going to move on to example number 3, and then I'll just have some questions for you after that. But this, again, very recent project that CRC announced. I may not say this right, but Copia Power. Okay. So you advised on the successful close. So this is a $1.24 billion debt facility for Centennial Flats
which I believe is just a pretty well-known project, right? 500 megawatt solar project, massive solar project, has it looks like let's see, 1,069 megawatts, like a gigawatt of battery energy storage tied to this thing in Arizona. Okay, so huge billion-dollar plus project. This is probably more along the lines of what I would think, or what someone might think if they said, oh yeah, there's this investment bank, they advise on the clean energy transition. I'd be thinking, okay, that's probably like big solar plus probably storage at this point. And so in this case, you advise Copia, so you advise the developer. So again, what does that mean to be advising in this type of transaction? How does a deal like this come together? How long does it take even to bring a deal like this together and kind of get it over the finish line?
Yeah, it's funny in the industry. I think sometimes debt gets overshadowed because of how critical that tax component is in renewable energy finance. So sometimes debt gets kind of, pushed aside as not as critical, but really that structuring can be so important and figuring out who is the right partner for those deals. We raise debt across the capital stack. So before a project is ready to start construction, we do raising development loans. This is more on the construction side. So the project has reached all of their development milestones. So they've got the land, they've got the permitting, they have interconnection, they have offtake, they have all of those good things, and they're ready to break ground. And so in that case, you need construction debt. And often that construction debt can also convert into kind of a term loan, so long-term debt during the operation of the project. And so we work on all of that. And it can also vary all the way down to one single project. Obviously, this is a monster project, so easy to do it in one single swoop. Often we're looking at kind of portfolio or multi-year warehouse commitments, revolvers, all of those different kind of optionality on the debt side. So yeah, we're highly active in that as well.
To get a project, and I'm sure of this scale off the ground, it's a lot of land, a lot of acreage. There's the environmental assessments. Like you said, there's all these milestones and boxes to be checked just to get all the approvals to actually get to a point where you can go start building these types of projects. How much is your firm involved in that diligence? You're signing off on it, right? I mean,
yeah.
So how much do you get involved in that aspect? Is it like, well, everything's audited, we got everything audited, boom? Or are you actually a little bit in the weeds on that stuff too, making sure that all those boxes get checked appropriately?
We are not engineers or, lawyers, right? So we are certainly doing a pretty in-depth in the weeds review of project documents from a commercial standpoint is how I like to frame that. We always caveat we're not those two things. And honestly, that makes a big difference. If we are taking a project to the market, investors know that cursory review has been done. There are no fatal flaws that we've identified. They have confidence that our models are showing realistic numbers that tie to the documents appropriately, et cetera. So we do a decent amount of that upfront work. CRC, one of our kind of things we pride ourselves on is going deep with our project teams and making sure that we really understand the intricacies of any of these assets because it's complicated. So it's complicated. As easy as we can make it for investors.
I only started smiling because as soon as it came out of my mouth, I was like, right, I think I actually know the answer here. They have to make sure like they're not the engineers. Their job is to go get the cash. Everything has to be above board.
But if we miss, right? If we show an investor something that has a major issue, that's egg on our face. Yeah. So we're very careful about that.
The projects like these get developed. They're huge. So let's just keep it more generalized. The FANGs, the Amazons, all the companies that are doing big data centers need huge power demand, doing huge renewables where they're buying the energy investment. About that in a second. But in this case, if I'm financing this solar project and the storage, and it's going to come online, and that's going to feed into the grid, the developer's making money on this deal, and over time I'm being paid back on my debt, some interest rate above prime, some premium, however that gets structured.
Yeah. So again, it varies for different projects, but most solar projects will have an actual buyer of the energy. So whether or not that is energy flowing directly to them or energy flowing through the grid to them, which is much more common, especially on these kind of data center, it's called a virtual PPA, a virtual power purchase agreement. So you will have a contract that says, if you produce this energy, I will buy it at this price. And that is very easy then for lenders to underwrite. You've got revenue coming in based on project performance, and an engineer comes in and says, yes, the project should produce this much. So that's relatively simple. Same with storage. There are a variety of contracts on how people are getting paid for these projects. The most simple is like a tolling agreement or a fixed price based on if the battery is there and we can use it whenever we want, up to this number of times, we will pay you X amount per month. Again, very easy to underwrite. Where it gets complicated, and we are seeing lenders get a lot smarter and get more sophisticated, and this is certainly an area of growth, is where there isn't that contract. So you're just deploying into merchant energy markets. So that means if you have a battery, you're assuming that you can charge the battery when prices are low, discharge that battery when prices are high, and that delta is how you're paying lenders. They're less comfortable with that, right? Because it's not a steady contract. You are taking risk on what the energy markets do and the performance.
Okay, so would that project then just command a higher premium if someone's going to demand a higher return? Okay, I think that's really interesting to understand different types of clients who you're advising on both sides of the transaction. It's a great lens to kind of understand the types of projects and what's going on. I was watching an interview you gave about a month ago with folks from the NASDAQ, and I was jotting notes and writing down something you said. And I was like, all right, well, I'm definitely going to ask her about this. And I was joking with Aaron, my producer, and I was like, I know what Britta was saying was really important. And I know it's important to the future of our country and the future of the clean energy transition. But it does remind me a little bit of like when I was studying for the LSAT or the GMAT, and I had to really pay attention and tell myself, like, this is the most interesting thing you're about to read for the next 2 minutes. So I would actually like focus on it and try and actually understand what was being said. So take that hopefully with a grain of salt. So the question to you was something to the effect of, what are you seeing in terms of innovations in financing and how deals are getting constructed? And you said, well, we're seeing some interesting things around carbon capture, tax credit financing. We're seeing huge shifts in like debt financing for distributed energy generation. So I'm with you there. And then you said something to the effect of, they're pioneering some broad warehouses, establishing broad financing platforms to be able to funnel the assets into these financing structures and remove tension and administrative burden for trying to deploy these assets. And then you said, we're seeing a ton of creative innovation among financing parties, newer investors, and our clients who are all structuring these facilities to really make sure we're deploying a large megawatts over the next few years. But I'm not sure I quite understand when you talk about like these warehouses for financing platforms. What are you describing there? What is this kind of creative financing innovation that you're seeing?
So to date, almost all of the project financing that has been done in this space has been project and portfolio based. I have this single project. I have these 31 projects. Let's finance this together and then move on. And then next year we'll do it again. We'll figure out what is the next things coming through. And not to put myself out of a job, but that is a lot of work and a lot of administrative burden and deal flow burden for lawyers, for project finance teams, everybody to kind of start over and do it again. And so what I am excited about is the shift we are seeing, and we recently closed a deal for Pivot Energy associated with this, that is a multi-year solution. So again, they don't have to hire me for 3 consecutive years. We put something in place this year that covers them for the next 3 years. It is all of their construction debt that they need. And as projects get built, it revolves, and it's a warehouse. They can house assets in this. The tax credit purchase is still in process, but again, it's a multi-year commitment so that they're not saying, okay, well, we've got, 100 million credits this year and we need to sell it to somebody, and we've got 100 million next year and we need to sell it to somebody. It's a single partner, and it's a corporate that's coming in that has confidence in their income over the next several years. And same with an equity partner that's coming in and saying, yes, we will be here for multi-years. So I think that just really kind of greases the wheels as far as they can then concentrate on developing and building assets as opposed to always worried about where the tax is coming from or the debt or any of those components.
Got it. Okay. Yeah, that's awesome. I get that. So if I'm the company, if I'm the developer, if I'm trying to deploy, of course, I'm excited. I see. Okay, so you're removing that administrative burden, the tension. I can do what I do best, and that enables things to move a lot faster. Why now? Why can that happen now where it couldn't happen in the past?
So it's kind of twofold. I think one is industry maturity. So the lenders are finally a lot more comfortable that you can kind of build a box, and as long as the project checks those boxes and fits into this mold, you've seen that project before, right? It's going to be something that's financeable, and if any issues arise, they can figure that out. So the lenders have matured a ton. Again, the benefit of these corporates coming into the market and the simplicity of the tax credit transfers is that you can set that I'm going to buy 100 million a year at a level that you do have some decent confidence in looking forward, that you're going to say, yes, I'm going to have the income to offset that. And so that has eased a lot of the tension, the supply demand tension in the tax credit market as well.
The last topic I want to turn to, maybe a couple more, but in the lens of clean energy, what's happening today. One of the things that you said recently, you were asked, okay, prognosticate, what do the next 6 to 12 months hold? What does the future hold? We have an administration change. This administration on the way out has been extremely friendly to clean energy and the transition. Less clear, although we can speculate about what may happen with the new administration. And so that was kind of the setup for the question to you. And your answer struck me as very interesting, where you had said, well, if you look at clean energy, we've dealt with policy uncertainty in the past. We've seen credits or incentives sunset or shift, and demand has stayed strong. And that seemed to be your point of view, that looking out, it feels like demand is still staying quite strong. Is that a fair synopsis of your view? And yeah, curious for you to expand on that. Yeah.
Yeah, and look, who knows what happens with the new administration, but I do think renewable energy, or the energy transition as a whole, has crossed that inflection point where the ball is rolling now, right? Consumer demand, corporate demand are all going to continue to fuel this industry and put projects in the ground. Now, maybe some of the power purchase prices change to reflect that if tax credits went away, for example. But I think that ball is rolling, and there is low likelihood of anything really derailing this industry from continuing to grow and the momentum that we have. Now, short-term policy uncertainty always can be an issue. And so most of the industry veterans are used to that and have taken a somewhat business as usual approach with an eye on what's going to happen. But I think the industry is certainly robust and strong enough now that it's moving forward regardless of what happens on policy.
I mean, that's heartening to hear. It's certainly heartening for me to hear, I'm sure for our listeners as well. Like I said, for someone who sits in your seat, who sees all these deals, who sees all the financing on the back end that needs to come together, that's good to know. And we hope you're right. The last thing I wanted to ask you is, you were being honored as a leader in this industry, also as a woman in this industry, in the investment banking industry and clean energy industry. But you're a partner in your firm that's relatively rare in this industry. And your comment that struck me, and I'm curious to get your thoughts, you had said, you've had a lot of people who've been wonderful, maybe played somewhat mentoring roles to you, but you haven't had a lot of female mentors playing these roles to you, because there weren't a lot of females who came before you, in that you give back, you work with women who are rising up in the industry, your firm is committed to diversity. So, I'm just interested to understand, really, like, what are you seeing today in terms of maybe that next generation and who is coming in? Obviously, there's lots of research in startup communities and in companies that, regardless of like what is the right thing to do, you get to better economic outcomes the more diverse you are in the team. And so there's a lot. I'm curious about it from a number of different points of view. Like, what are you seeing?
For me, coming up, right, you're layering on top of each other two traditionally male-dominated fields, right? Energy and investment banking. So there have not been a lot of senior women in the space. There have been a handful that have been very helpful to me over the years of my career, but it is not a well-populated group of women. So we at CRC and myself are both really committed to this. And so we take a very specific view on recruitment, a very specific view on how we're nurturing and bringing up our employees and making sure that they have the resources and understand that this is possible and you can be a senior woman in this field, and it's improving. And I think we are quite pleased with our makeup of our employees at the moment and what that looks like and the traction we've gotten to date. But it's not easy. It's still a lot of work to be done in this space.
And so as you look forward, you're optimistic about clean energy and this transition. there's more work to be done, on this topic, certainly bringing,
Absolutely.
and as I'm hearing you say it, it's having women really see a path to senior leadership. How does that change? Is it just time, or is it?
I think it's time, and it's one woman at a time, right? It's continuing to support and bring them up the ranks and make sure they're getting the opportunities that they want to. For us, right, we don't do huge amount of kind of senior level hiring. We like to grow organically from the bottom up, and so we have made a discernible effort to do that and make sure that we have a diverse class of junior bankers and mid-level bankers. And we've got some senior women already. So it takes time and it takes commitment and just kind of keeping an eye on it. I think my partners would agree that it has benefited us to have women in more senior roles and throughout the organization. So the proof is certainly there.
Well, I appreciate you touching on that, and I appreciate this whole conversation. It was certainly enlightening. I think the work that you're doing, that your firm is doing, is extraordinary. It's great to have a glimpse into it, and I know for our listeners, it will be very interesting to have this glimpse too. So, Britta, thank you for your time, and wish you the best of luck.
Well, thank you. Very much appreciate being on.